The Federal Reserve feeds the public a very specific textbook narrative. They suggest that when the job market is booming, people naturally have surplus cash to spend, and it's that relentless consumption that supposedly drives up prices. At first glance, the data seems to back them up. In April, while the market expected a bleak 70,000 new jobs, the official result came in at nearly 120,000. But we are seeing a massive contradiction. While job reports move higher, actual consumer confidence has plummeted past 2008 and 2020 crisis levels, hitting lows we haven't seen since 1952. When official employment data is this disconnected from the reality of terrified consumers, it suggests the numbers are masking a deeper crisis. The math of a wealthy spending America doesn't actually exist. To find the truth, we have to look at how the government actually counts a job. Consider a senior engineer who gets laid off from a high-paying tech role. To survive, they start driving for Uber, delivering food, and stocking shelves part-time. On paper, the government registers that as the creation of 3 brand new jobs. In reality, one middle-class career was destroyed and replaced by 3 exhausting survival gigs. This quirk in the data projects a fake boom. If people are this broke, why are prices still exploding? It isn't because domestic consumers are on a shopping spree. We are suffering from imported inflation. Geopolitical conflicts have choked global shipping routes, sending energy costs into the stratosphere. When oil prices spike, foreign manufacturers pass those massive manufacturing and shipping costs directly onto you. This is the stagflation trap. Basic survival costs are soaring due to foreign energy prices, while real employment is collapsing beneath the surface of the gig economy. The newly appointed Federal Reserve Chairman has signaled a specific policy directive. He intends to immediately slash interest rates while continuing to shrink the Fed's balance sheet. These goals are fundamentally at odds. Cutting rates floods the market with cheap debt, while shrinking the balance sheet sucks dollars out of the global system. This contradiction is driven by the fact that demand for long-term U.S. Treasury bonds has essentially evaporated. Even with yields hitting 5%, foreign investors are walking away from 30-year debt. Because no one wants long-term bonds, the U.S. government is surviving on a short-term credit card. They are borrowing billions every morning just to pay off the billions that came due the night before, debt that often matures in just a few weeks. This creates a systemic vulnerability. If the Fed slashes rates, the yield on those short-term bills collapses, and the international lenders who fund this daily cycle will walk away. Without that constant influx of cash, the federal government cannot pay its immediate obligations, risking a systemic default. To avoid that collapse, the Fed is looking back to 1946. After World War II, the U.S. survived an identical debt crisis using a strategy of high interest rate expansion. Step 1. Keeping short-term rates artificially high forces global funds to park trillions in short-term U.S. paper for safe yield. Step 2. The Fed prints trillions to buy unwanted long-term bonds, artificially suppressing interest rates to prevent borrowing costs from exploding. Institutional capital is already positioning itself for these hidden mechanical flows. To understand how to track this capital and protect your own portfolio, you need to register for the Stewardship Finance Academy's free stock investment masterclass. This strategy traps global wealth inside the American system, forcing foreign nations to fund the U.S. government, while the public remains blind to the maneuver. There is a mathematical cost to printing trillions to buy up government debt. It ensures that inflation will likely remain sustained at around 4 or 5%. Click the link in the description to secure your spot in the Stewardship Finance Academy's free stock investment masterclass before it moves offline. Take action, and I will see you on the inside.